Welcome to Online Trading Campus and welcome to our unique OTC Futures course. Futures trading began in the mid-19th century in the United States with the establishment of central grain markets where farmers could sell their products for either immediate delivery or future delivery. 2 centuries later, the futures market plays a vital role in the entire world's economic engine. In the futures market, producers and consumers have control over the future price of assets or commodities which they will sell or buy. Futures trading has benefits that the forex and stock market are not able to provide, and it is a brilliant tool for traders to participate in a wide variety of markets. It is actually the only set of markets in the world where traders have true non-correlated and diverse markets to choose from, such as stock indices, interest rates, energies, precious metals, and agricultural products. So let's start with our first module, Fundamental Awareness. Before we dive into the first lesson of Module 1, let me give you a brief overview what topics we are going to discuss in this module. In Lesson 1, Futures Basics 101, we will dive into the basics of futures trading. I will thoroughly explain to you what futures are, show you the different ways market participants use futures and the benefits that futures provide. You will obtain a strong understanding of how futures work and whom you are competing in the most diverse market in the world. In Lesson 2, How Futures Work in the Real World, we will look at how industries use futures contracts as a risk management tool for a variety of assets. For instance, the profitability of an airline company partially depends on the cost of crude oil. By buying a crude oil contract, the airline can secure a specific price at which it acquires fuel. In this lesson, you will learn how futures work in the real world and what they are used for. I will guide you through real market examples to understand how industries may benefit from the added price protection when trading futures. Last but not least, Lesson 3, Global Futures Markets. There are many futures exchanges around the world, and the variety of markets is vast. I will start this lesson by giving you an overview of the biggest futures exchanges in the world and help you to find the most suitable for your specific requirements. On top, I will classify most of the important futures markets into 5 different groups. During the classification process, we will highlight the advantages and disadvantages of each group and the market. I will guide you to find the best markets for your trading style and experience level. So now I hope you are excited and let's jump right away into Lesson 1, Futures Basics 101. So in this lesson specifically, we will demystify the question what futures actually are, talk about the history of futures, and look at the market participants in the futures market. Let's start with the most popular question I hear. What is a commodity futures contract? This is a fair question considering most investors are more familiar with stocks and the forex market. Let's look inside the commodity futures market and remove this mystery and help answer that question in a little more detail. Commodities are products that each of us must have every day of our lives. Unlike a stock of a company that makes mobile phones or cars, we must have certain commodities to survive. Consider the house you live in. On a daily basis, we all need food, clothing, transportation, and shelter. It takes physical commodities to produce each of these items we will need. These commodities have been traded for well over 200 years in the US alone. Japan goes back even further with rice trading, but we will briefly look into the history of futures in a couple of minutes. For many years, before futures contracts even existed, the producers of these commodities, the farmers and miners, had to endure the risk of price volatility for these commodities. They were generally at the mercy of Mother Nature that their products would be in good supply when it was time to bring them to the market. To compound the problem, the producers were all bringing their commodities, aka cash commodities, to the market at the same time for harvest season, livestock slaughter, etc. We all know what happens to price when there is excessive supply, right? Exactly, the price typically declines, causing these producers to lose money. Another problem with these cash commodity transactions was there was no specifications on the quality, quantity, date of delivery or legal recourse if the other party did not fulfill their obligations of the product that was being delivered to the buyer. You can now see the hardships that these businesses had to incur to do business in the cash markets without any price protection. Keep in mind that any price increase absorbed at the wholesale level, which are the processors, is passed on to the retail users, you and me, of these commodities. Can you imagine what prices we would be paying for items such as bread and gas today if these producers did not have the futures market to hedge their price risk, which basically acts as an insurance? With all the demand for exchanging these commodity products, there needed to be some central place to conduct this business with multiple market participants in order to obtain a fair market price. It was at this point futures exchanges were created. These exchanges provided that central location for buyers and sellers to meet and auction their products in an attempt to get the best price possible. These same exchanges created contracts on these commodities that had specifications listed for each commodity. At this point, everybody knew exactly what they were buying or selling based on these contract specifications. To cut a long story short, a futures contract is a mutually binding legal agreement between two parties, the position of the buyer, your long position, and the position of the seller, your short position, to be fulfilled in the future. So a futures contract is a standardized contract to buy or sell a specific product of standardized quantity, quality, and type of fulfillment at a certain date in the future and at the market predetermined price, the futures price. Each of these contracts will be then executed on an exchange electronic platform. Futures contracts are not like buying securities like a stock or bond, where the prices of the stock or bond are the actual cash price. Futures contracts are derivative contract. Derivative is the name used for a broad range of financial instruments that derive their value from other financial instruments, aka the underlying. In case of commodity futures, the underlying is the cash commodity. Let's have a look into the specifications of a contract. As I said, contract specifications are defined precisely and dependent on the nature of the product. Standardization enables transparent trading. Let's review some of the specifications you might find in a commodity futures contract. But all specifications we will discuss and explain very much in detail during the course of the entire presentation. If you would like to see a specification page for the corn futures contract traded at the Chicago Mercantile Exchange, you go here. So the website you go to is cmegroup.com. This is the biggest futures exchange in the world, which we will talk about in a minute. Here you find most of the markets that we will trade. Then you click Markets and select the market you want to look at. Since we want to look at corn futures, we have to select agriculture. Also here you find subcategories of agricultural markets. Since corn is obviously a grain, we select grains and oilseeds. And here on top you already find corn futures. You click on it and select contract specs, since we want to know the specifications of corn futures. So now let me explain some of the specifications in general. Contract unit. Here you find the size of the actual contract you're trading. In the case of corn, we are looking at 5,000 bushels per contract. This is the minimum amount you can trade for this particular contract. Unlike equities or forex, you cannot trade partial contract sizes. There are mini and micro futures contracts, but there is so little volume that the risk increases using these products. We will discuss this part in upcoming lessons. Price quotation. When reading a price quote for this commodity, you need to know what the value represents. Corn, for example, are priced in US cents per bushel. Trading hours. Each contract will have their unique trading hours. Many futures markets are traded during two different formats. Pit trading, which is also called the open outcry, and electronic trading. Some futures are purely electronically traded. When looking for the most liquid time of the day to trade a commodity futures contract, look to trade during the open outcry time, also known as regular trading hours, short RTH. This is all something we will explore further, since this is a very critical topic when it comes to futures trading. Minimum price fluctuation. Each commodity has its own unique specifications, and this includes each price increment. When corn moves the minimum price fluctuation, the move is in 1/4 cents increments. This is equivalent of $12.50 per tick. Markets can trade in larger tick increments, but never less than the minimum tick. Product code. Exchanges create a root symbol for each commodity traded, much like a stock will have a symbol. MSFT, Microsoft, AAPL, Apple, etc. Many commodities now have different symbols for the same commodity. This is to help identify if the commodity is pit traded or electronically traded. Since a commodity futures contract is simply an agreement between a buyer and a seller, you will never run out of futures contracts. As long as there is a buyer and a seller, there can be a contract created. Unlike equities, where each company only floats a fixed amount of shares that are tradable. Listed contracts. Unlike stocks, all commodity futures have expirations involved with each contract. Each commodity will have distinct contract months to trade. These months are usually related to the cycle of the commodity. Example, corn has contract months that involve the planting season, growing season, harvest season, and the livestock winter feeding season. Settlement method. This area tells you if the commodity futures contract calls for physical delivery or cash settlement. Physical delivery means you would have to deliver or take delivery of the contract if held until expiration. Cash settled means you would be responsible for paying any losses in cash at expiration or having cash deposited in your account if profitable. If you are really interested in the settlement procedures, you could click on that link. But I doubt any one of you wants to actually sell or buy physical corn in a huge amount. So let's skip this part. Price limit or circuit. Some commodity futures contracts, not all, have daily limits imposed by exchanges. These are prices set the previous day for the maximum amount the market may rise or fall the next trading day. It is important to know if the market you are trading has these limits. Always know this information to avoid being caught in a limit move that can be devastating to your trading account. Termination of trading. Just briefly, because also here we will spend a lot of time on this topic in upcoming lessons. Your broker will typically let you know if you're near the expiration of a contract. As always, it is a good idea to know about this ahead of time. On this date, the contract is expired and put in the history books. Grade and quality. The exchange determines what the quality must be of this commodity before it can be accepted for delivery to offset a futures contract. This allows everybody involved in the transaction to know the quality of the product being delivered. This is important to rangers who only want the best corn fed to their livestock. Let's briefly talk history. The earliest recognized futures trading exchange is the Dojima Rice Exchange, established in 1710 in Japan for the purpose of trading rice futures. Western commodity futures markets started trading in England during the 16th century, but the first official commodity trading exchange in England, the London Metals and Market Exchange, was not established until 1877. The United States had the earliest official commodity trading exchange in the West, the Chicago Board of Trade, short CBOT, formed in 1848. The CBOT arose in the aftermath of railroads and the telegraph connecting the agricultural marketplace hub of Chicago with New York and other cities in the eastern US. The first traded futures contracts in the US were for corn. Wheat and soybeans subsequently followed, and these three basic agricultural commodities still account for the bulk of trading business conducted at the CBOT. The next large market to begin trading futures contracts was the cotton market. Forward contracts in cotton began trading in New York in the 1850s. leading eventually to the establishment of the New York Cotton Exchange, NYCE, in 1870. Futures contracts for other products developed over time, including commodities such as cocoa, orange juice, and sugar. Massive US cattle production led to cattle and pork futures contracts as well. The 1970s saw a large expansion in the futures trading markets. The Chicago Mercantile Exchange, CME, started offering futures trading in foreign currencies. The New York Mercantile Exchange, NYMEX, began offering trading in various financial futures including US Treasury bonds, T-bonds, and eventually futures in the stock market indices. The Commodities Exchange provided futures trading in gold, silver, and copper, and later added platinum and palladium when gold ceased to be pegged to the US dollar. The rapid expansion of trading in financial futures led to the creation of futures contracts on the Dow Jones and S&P 500 stock indices. Although there are now futures trading exchanges worldwide, the US exchanges remain the most widely traded. Today, the CME Group is the world's largest futures exchange, formed by the 2007 merger of the Chicago Mercantile Exchange, the CME, and CBOT. Let's move on and look who are the traders in the futures market. Futures exist for one reason and one reason only: to manage price risk. Some form of futures trading has been around for hundreds of years, as we have seen, for people who have owned a physical commodity or needed to own a physical commodity. These people or entities would be called commercial traders. They use the physical commodity in their day-to-day business. Perhaps they have grown it, extracted it from the earth, or produced it. These commercials would be known as producers. If they needed to purchase a physical commodity to process, refine, or manufacture, then they would be called a processor. Either way, these two commercial types have something in common: price risk. We would all like to own something and have the price go straight up and then sell it. Or we might need to purchase something and we would like prices to keep falling until we needed to actually buy it. The perfect world it would be, right? But in the real world, these commercials know that these conditions do not exist on a reliable basis. Let's look at the cash corn chart provided by More Research that illustrates what month of the year tended to be the high and low prices for the last 30 years. MRCI makes these charts available for traders to help time cyclical tops and bottoms. As traders, we would then take this information and find supply and demand zones to buy or sell at. Having these seasonal highs and lows is known as having an edge in trading. The magenta line shows the average price for the last 30 years. If you owned corn and had just planted your annual crop in the springtime, you can easily see what the price is most likely to do by the time you harvest your crop. It shows that corn typically makes its seasonal highs in the early to mid-spring and continues to decline right into the fall harvest season. There are some fundamental factors behind this seasonal pattern. In the spring, corn has been depleted from the grain elevators, reducing supply and causing price to rise. In the fall, corn will be harvested by all producers and brought to the market, creating an abundance of supply, thus lowering prices for the physical crop and futures contract on corn. As a producer of corn, you would be at risk of losing profit by the time you harvest your crop unless you protect yourself with an insurance policy against lower prices. This insurance is known as selling a corn futures contract that will expire in December of that harvest year. The futures industry knows this as hedging. Now, at harvest time, you will lose on your cash crop when taking to the grain elevator, but the futures contract you shorted will be protecting your profit as it makes money with falling prices of corn. As long as the basis, difference between cash and futures, stays relatively the same, the hedge should protect the commercial producer. The commercial processor in corn could be a ranger in need of feed for his livestock, ethanol refiners, or a food processor. An example, well, a company, for instance Mills, produces canned corn. If corn prices rise, Mills' production cost goes up. This puts mills obviously at risk. To protect themselves against higher corn prices, mills can hedge corn by buying enough futures contracts to cover the amount of corn they intend to use for processing. This allows mills to calculate raw material costs in its planning as a fixed cost. So what we have just seen is that the company mills, in this example, the processor, is at risk of having prices rise before he can purchase the cash crop. Looking at the chart, we see that corn usually has its seasonal lows from September to November. This is simply because of the massive supply of corn being brought to the market at the same time. It is at this time the processor can be buying futures contracts at today's low prices due to the harvest season, but using contracts for delivery at some future date when the processor actually needs the physical corn. By using futures market, the processor won't have to pay for storage costs until he needs the corn to process. Both the producer and the processor may use future contracts for their hedging. For these reasons, we have the futures markets. Commercials are the reasons they were created, and today they still exist because the commercials must have them to manage price risk. Who else is involved in the futures market? Well, just to name a few, airlines hedge fuel costs not to lose money on booked seats as oil prices rise. A rising oil price, though, would generate profits for long position trades in the futures market, which offsets the loss in their daily business. Jewelry factories hedge gold or silver to stabilize costs, which would otherwise be passed on to the end customer, us. So I hope this lesson gave you some insights on what futures actually are, a little bit of history, why they exist, and who is involved in the futures market for an actual purpose. In the next lesson, we continue looking how futures work in the real world, because as many traders begin in the futures market, I feel it is important for each trader to understand the market they are trading.